Angel is brought to you by LinkedIn. You already know LinkedIn as the world's largest professional network. It's also a better way to find great talent. Go to linkedin.com/angel and get a $50 credit towards your first job post. Terms and conditions apply. And Salesforce Essentials. Jumpstart sales and support by leveraging the world's #1 CRM at a startup price point at just $25 a month per user. Go to salesforce.com/angel for an additional 50% off and a free onboarding call.
Welcome. It's time for another episode of Angel, the podcast that is a complement to my book, Angel, and the Angel University program, which is a half-day course, about 4 or 5 hours with a dinner after it. We do this in about 10 cities a year. We're on a mission to educate people about how to angel invest, how to do early stage investing intelligently and in a considered fashion so you get a better outcome, both for society, picking great companies that are human positive and species positive for all of us and for the planet, and how to get great returns. Angel investing and early stage investing is brutally hard. And everybody's got a different theory or thesis on how to do it in a positive fashion. I've done over 200 investments, and I do it here in Silicon Valley. 7 of them have turned into unicorns. You know some of those companies: Robinhood, Calm.com, DataStax, Wealthfront, Calm.com. I mentioned them twice because I'm so proud of it. And the taxi company, Uber. So what we like to do here on this podcast is bring in other investors and hear how they do their work, how they source companies, how they make a decision to invest or not invest in those companies, how they stay in contact with them, what to do after they invest, how to evaluate founders, how to evaluate ideas, how to evaluate the traction and the metrics, and should they invest and continue to invest in those companies as time goes on. My guest today is Ben Ling. He is the founding general partner of Bling Capital. Get it? Ben Ling Bling. Welcome to the pod.
Thanks for having me.
You started investing, like a decade ago?
Yeah.
How did you get into it?
Initially, it was really just keeping in touch with the next generation of entrepreneurs. And I was investing with Jeremy Stoppelman, with Keith Raboy.
How do you know those gentlemen? Obviously part of the PayPal mafia.
I know them for a while, yeah.
Were you in the PayPal mafia, or were you just around it?
No, I was not. Yeah, I was just around it. I mean, I was running commerce at Google, so I started a competitive product at the time. And so I got to know a lot of the ex-PayPal guys, including Max and Keith and so on and so forth.
Got it.
Yeah.
And they were running around town, 15 years ago during the aughts? 2002, 2006 era.
That's right.
When nobody believed in the technology industry, and you could find lofts and apartments in San Francisco for $1,000 a month.
And you could commute from San Francisco down to Menlo Park in 25 minutes.
Right. And now they're filled with buses deploying thousands of developers who are getting paid $250,000 a year to sit on a bus for 2.5 hours a day.
That sounds about right.
Can you imagine how backwards the world has become? You're the most successful developer, in-demand person, and you decide to live in a city that's crumbling and filled with crime and feces and drug addicted. Just the human condition here in San Francisco is horrible. It's a terrible city to live in.
We're ready for you to be mayor.
Thank you, Ben. MayorJason.com. That's the next podcast. The crazy thing about it is they decide to not live in the glorious peninsula where it's sunny and warm. They live in rainy, cold, scary San Francisco and do the commute that should be the reverse. It's bonkers. But here we are.
It is a little bonkers, but I think it's the nightlife. It's like the city, or at least
there's
some
that
draw.
Good?
I don't know that it is anymore.
Yeah.
But at least that's the theory, I think.
It makes no sense. What was it like in the aughts? Aside from the easy commute and
what
the cheap rent.
What is that word you're saying? The
aughts?
Aughts?
I think they refer to the 2000s. You have the 70s, the 80s, the 90s.
Yeah.
And we have the 2010s. That period is called the aughts. 2000 to 2010 is called the aughts. I don't know why. Yeah. I don't know what the origin of aughts is. Emmy award-winning producer Jackie does, and she's about to put it into the chat room for me.
Got it. Well, that era, so the early part of that era was very depressing because the dot-com bubble had burst. And basically half the valley had been laid off or the companies had gone under. So there was actually not a ton of activity at the time in terms of both technology, investing, and then also in terms of job opportunities.
Yeah.
So it's actually a pretty depressing time. And I think that gave Google a really big opportunity to hire up basically, all the talent in the Bay Area.
Yeah.
From like, the early 2000 period to like the mid to late 2000 period.
And they did so famously in a way. The cynical look of it was to keep people from creating competitors. So this like TV show Silicon Valley talks about Hooli and people being on the roof and investing. There was some truth to that. They just wanted all the smart people, since they had a money printing machine, to not be out there starting companies and to be working for Google.
That actually happened, I think, much later in Google's life cycle, because in the early days, I think there was a draw to Google because of the change the world mission. That's one. And the second was all the talent people working there. Yeah. And so for the period of time that I was there, I think it was 2004 to 2012, the up until 2007 or so, Google really didn't have any competition in terms of hiring. It was only when Facebook showed up in around 2007 that Google actually faced serious competition in terms of hiring. Before then, it was sort of, at Google, we would just win 99 times out of 100.
Yeah. If there was 100 people who were going to be hired this month at this talent level, you were going to win.
Yeah. Like
high 90s.
Yes.
Just because you had the bankroll and
correct.
Game respects game. Like if you're smart and you're like, wow, I interviewed there and there's 7 smart people. I went to some other place and it was like, what's this like tiny little startup? Forget it. I'm not interested.
Yeah. And then that changed in 2007 when Facebook was really on its meteoric rise,
right?
In terms of user growth.
Yeah. For people who don't know, aught is a variant of not. Sir Charles is telling me the Brits call that period, the 2000 to 2010, the noughties, as the Brits are apt to do.
I learned a new term.
There you go. What was the first investment you made? Do you remember?
The first investment I made, I believe, is Palantir.
So your first time up at bat, you hit a massive home run. What was the size of the company at that point in the stage, and how did you get in that deal? I assume from the PayPal mafia.
Yeah, it was. I think the then CFO reached out, and I invested along with Jeremy and Keith in Palantir. Yeah.
I think Keith was on season 1 or season 2. I'm not sure of this very podcast, or he may have been on This Week in Startups. So you've invested in over 100 companies. Quora, CafeX, Lyft, Gusto, Airtable, Square, Palantir, 15.5. I'm in a couple of those myself. What is your thesis for investing in companies? How do you have such a great track record? I mean, obviously, you and I are both started investing in the last decade, so we kind of have the advantage of like surfing when the tide was coming in.
Right.
But putting that aside, there is something to your ability to select. When you look back on it, what did all those things have in common? What is your pattern matching?
Yeah, I think it's 2 things. I think the first is really great founders who are mentally tough, mentally agile. They're stubborn, but they're not so stubborn that they can't take feedback from other entrepreneurs and other investors. So that's the first, just a really great founding team. And the second is a really large market. And I think that combination, essentially, so in terms of the really large market, it doesn't have to be a really large market today. As long as it's going to be a very large market in 5 to 7 years, I think that's what matters the most. So I think those are the 2 main criteria. Obviously, there's other things like, is the product currently working? But in the earliest stages, sometimes it's just a team and an idea, right? And so you're really investing on the team in the space.
What's the difference between a stubborn founder who can take some input and somebody who's just an insane, narcissistic personality disorder, uncoachable person? And how does that correlate with success in your mind? Like, unpack that a bit.
Yeah, so I think that it's important for a founder to be stubborn and stubborn enough to stick to it even when times are really tough. But the stubbornness should only go so far. So in my opinion, a great entrepreneur can listen to feedback from others and incorporate that feedback. Sometimes they'll say, yes, I agree. And many times they'll say, no, I don't agree. And here's why I think differently. But I've considered the feedback. And this is why I'm doing this. I'm choosing this path. Right. There's certain entrepreneurs that are certainly so sure of a path that they're right. And they might be right. But that doesn't necessarily mean it's going to be great to work with them. Right. So I think for me, the perfect mix is someone who's stubborn, is really like tied to their vision, but is willing to listen to different viewpoints and then incorporate those viewpoints and thoughtfully accept them or thoughtfully reject them.
Got it. So there's some EQ, emotional intelligence here that is necessary for a founder to be able to say, hey, I've got world-class investors, I got world-class partners, I got world-class team members. I know where I want to go, but I have to be able to work with them, take their input, and either make them feel good about saying, yeah, that's a great idea, but we're not going to do it. That's not happening, and here's why.
Yeah. I mean, the other thing to think about here is that in terms of hiring, if this person can incorporate feedback from outside sources and thoughtfully address it, I think it's also important from a hiring perspective, because if you're going to work for this person, you want to make sure that you feel like you understand what this person stands for, and then also what this entrepreneur, if you have feedback as a C-suite, member, or even just an engineer, that there's some degree of trust and communication versus like it's my way or the highway, just get on board.
All right, when we get back from this quick break, I want you to address one of the most frequent questions I hear from new investors, people who don't have 10 years and 100 investments, which is, how do you determine the valuation of an early stage startup when there's so little data to go on and we see such massive variability with one group asking for $5 million with more performance than another group asking for 15 or an uncapped note with less performance, when we get back on Angel the Podcast. Hiring is so hard. You are suffering right now, and I understand that. I'm suffering too. I've got to hire people. I've got 200 portfolio companies. We're all trying to hire talent, and it's a record low unemployment here in America. Well, I have the solution for you, and you are already using this product. It's LinkedIn Jobs. It helps you fill all these open positions you have. 500 million people are active on LinkedIn. You know that. And they come every day to make connections, to grow their careers, to discover new job opportunities. 90% of LinkedIn users, according to a survey, are open to new opportunities, but they are not actively looking. These are called passive job searchers. LinkedIn Jobs gives you access to an entirely different demographic than anywhere else in the world. In fact, we found our director, Sir Charles, and our marketing manager, Maureen, on LinkedIn. LinkedIn is amazing, and you need LinkedIn Jobs to find the right person for your business. You're going to get to target your job promotion. It's going to recommend matches, and it does candidate management. It's a dashboard that lets you track everyone from application to hire, all in one place. And you really need that candidate management so that you have this beautiful, elegant dashboard, and it will track everybody from application to hire so you don't lose any of those premium candidates. LinkedIn Jobs uses knowledge of both hard skills, cloud computing, social media, video productions, and soft skills like collaboration, time management, to match you with people who fit your role best. So here's your call to action. It's a really great offer. I can't believe they're doing this. I want you to go to linkedin.com. That's super easy. When you type the letter L in your URL, it's going to fill in linkedin.com. We all know that because that's the place you visit most. That begins with an L. And then /angel. linkedin.com/angel. You know me, I'm an angel investor. You're listening to Angel Podcast. linkedin.com/angel, and they will give you $50, a fitty, 50 for free, just for posting your first job. So get that $50, and you do that by going to linkedin.com/angel. Terms and conditions, of course, apply. Thank you to LinkedIn for helping us find Sir Charles. He has been a real gem. Okay, let's get back to this amazing episode. My guest today, none other than Ben Ling. You can follow him on the Twitter, Bling, B-L-I-N-G, get it, with a zero.
With a zero.
And now he has Bling Capital. Before that, he was a general partner at Khosla. We put in 6 years there. Vinod is an interesting personality. How is he to work with?
He's very, very talented, has very strong opinions.
Yeah.
So you can learn quite a bit from him.
Very strong opinions is what stood out in that sentence. Is he as intense as he seems? I've interviewed him.
Yeah, he's intense.
Why is he so successful?
I think he's successful for a variety of reasons. One is that he's just very, very smart. So he can see ahead, and he can see like 2 or 3 or 4 steps ahead of everyone else, so he can see around the corners. The second, he has a really broad breadth of experience. And the third is he has conviction. So he's willing to bet when others are not willing to bet. And I think that's really important.
Yeah, that is an important lesson. We see such lemming-like investing here in Silicon Valley. I've always found it confounding when people are like pouring money into the 16th, Slack competitor or Postmates, Uber, Lyft competitor and not giving even a modest check to something that is truly innovative out there. It's so weird. You find this in your career?
I definitely find that to be true.
Yeah.
And then the other part of that.
How do you police it in yourself? And then,
Well, the other part of that I think is true is that once a lead is identified in an investment round, then all sorts of people want to follow. Right. So that's the other part of the lemming-like behavior that I thought you were going.
Yeah, no, that is one. You definitely you have a twofold lemming-like behavior. Now that I unpack it from your feedback, you have a lead investor goes into a deal. Now it's oversubscribed. The same investors who passed now want to get back into the deal.
Often,
bizarre.
Yeah.
Or into the next round, try to do a make good. And then you have 2 companies had success in a space. Now 20 other investors have to bet the 6th, 7th, 8th, 9th horse in the race, which makes no sense.
Agree.
We went to break. How do you police yourself with that? Do you think about that yourself, like your own mental state as an investor and sort of sportscasting or handicapping or analyzing your own behavior in decision making? Do you do that as like some regular practice?
For me, I really focus on the 2 criteria we talked about earlier, just
team.
the quality of the team and then the size of the market.
Yeah.
Typically, I will not want to back the number 2 or the number 3. That said, there's certain cases when the market is so large that you can have multiple winners, and many markets are not winner take all markets. So I think that's sort of the ancillary, like the exception that proves the rule, which is that when you have $100 billion revenue markets, then sometimes you can have 2, 3, 4 winners.
Yeah.
Right. So.
Yeah. Enterprise.
Yeah.
Comes
Enterprise.
to mind.
Yeah.
Even if you just take consumer apps, like, is there going to be one winner in social media? Right. No, there's like 6 or 7 major players.
That's
and
right.
It just happens to be that one gobbled up 3 of the top 6 or 7. When we left for break, how do you think about valuations, or do you not think about them at all in the early stage? When you meet a company that's asking for only $5 million as the cap on their note, and they've got $500,000 in sales. And then you meet a company that is asking for $15 million. They've got no sales. Their team's got holes in it, but they're asking for 3 times as much. How do you make sense of all this? Do you worry about it? Do you negotiate it?
Yeah, I think it's really tricky because it's more of an art than a science. And I think, both those polls that you mentioned happen quite a bit. For me, I tend to focus on, so from the fund, I typically will write somewhere between, let's say, a $400,000 check to $1 million check for 10%. So I tend to stay in the, 4 million post-money, 10 million post-money range. I like to be disciplined because I think, we've had conversations about this, which is that if you think about it, at a $5 million post-money valuation, if you do 2, let's say, 3 investments there for $5 million each. Sorry, for 500,000 each, that's 1.5, right? Mm-hmm. And then so you have 3 shots on goal. But if you have, for example, an 8 million post, and you do 2 investments for 10%, that's 1.6. So you have 3 versus 2
shots on goal.
Exactly, shots on
you get
goal.
To play 3
so it's a 50%
hands
exactly
of poker versus 2. You get to see 3 flops versus 2.
Exactly.
Why wouldn't you do it?
And then when you go to like the 20 million post money, you do 2 million for 10%. So then you have, then the math
4 shots on goal for 1.
Exactly.
It makes no sense.
Right.
This is where this is what the founders who are going for these sky high valuations don't realize that they're doing is they're taking the savvy investors who actually think through the betting strategy and the ones who have the most deal flow, which would be people like us. And they're like, well, I have a lot of deal flow here. I'm picking between 20 great companies this month to invest in. You're just not going to be on that list. You've eliminated the top ones. How do you think about those high valuations? We hear a criticism of like uncapped notes and raising too high a valuation. Why is it good or bad for a founder let's put the founder perspective on. We understand for an investor, we just went through the math. You get 3 or 4 shots on goal versus 1. What are the pros and cons for raising at sky-high valuations?
Well, it's tricky. I think I would bucket into 2 sets of founders. One would be an established founder that's seen success, like big success.
Evan Williams, Mark Pincus,
right.
Whoever. They got their next
right,
thing.
Max Levchin.
Sure.
Right. So here, we'll call that category A, and then we'll call category B, others that are, let's say, first-time entrepreneurs that don't really have a track record in operating or any sort of background other than, sheer passion and IQ, EQ.
Got it.
So in category 1, I think in that case, that these are quote unquote famous founders that can command a premium. And I think for better or for worse, as an investor, I just want to put as much money as I can get in that round.
Right.
They're proven operators. They have networks. They can hire. They can, maybe the market isn't exactly what they expect it to be, but you can trust them to navigate and trust them to twist and turn. So risk adjusted, they tend to be. I think they, when they command that premium, fine, that makes sense to me. I think for if we look at category 2, which is most entrepreneurs, I think it's a little trickier. So I think there's pros and cons of raising at a high valuation for the for the entrepreneur. And what I would say is that the pro obviously is that as an entrepreneur you get less dilution if you raise at a higher price. But I think there's a lot of cons that come with that. I think A is that a lot of the quote unquote investors that may consider themselves high value add usually will opt out of those rounds because the price is just simply too high. We just talked about that.
Right.
B is that you're kind of setting yourself up, as the founder, to have a really high bar for your next round of financing. So put differently, the easiest way to illustrate this point is to use really extreme examples. Because if you're a founder at raising the seed round and you raise at $1 billion valuation, you raise $2 million at $1 billion valuation.
Right.
Well, okay, the next round has to be higher than that for you to have an up round. And it's very hard usually to raise a Series A at a greater than $1 billion valuation. It's not common.
You would need to have
unheard of
9 figures in revenue, in all likelihood, over $100 million in revenue. Yeah. Or some
miraculous event, right?
Okay.
And so therefore
that's super extreme.
And so that's the easiest way to illustrate it. Obviously, you're not going to raise at a $1 billion valuation in your seed round, but 20, 30, at some point it becomes much, much harder to raise your next round as an up round if your price is too high. And the way that sort of manifests itself is that a lot of the Series A investors will look at the last round and say, I can't mark it up. And so therefore, I might not want to engage. I might just pass. So when you otherwise would have had investors engage and actually really dig deep and possibly be great partners for you, they may just pass out of the fact that the valuation expectations are too far off.
Got it.
So you're limiting optionality. So that's part B, which is you limit optionality from an investing standpoint. And then also C is you limit optionality from an exit standpoint also.
Because your investors have to approve that exit in all likelihood. If they invested at 20 and now you get a $25 million offer, you own 95% of the company or something, right? Because you only diluted 5%, and they don't want to sell.
Yeah, or if you raise it at 20 post and the offer comes in at 15, it feels like it's a loss. It feels like you've done something wrong.
Yeah.
Right, and the employees are not necessarily excited. The investors are not excited, and so it turns out to be bad for a variety of reasons.
I'm trying to think about if we could come up with here at this very moment a guide or a metaphor for founders, because it is alluring, having been a founder, to raise at high valuations. It's a nice feeling to have the value of your company be that high because you get to look and say, well, I own 40% or 30%, and wow, so I own 30% of 20 million. I've got $6 million. It's a nice feeling, but it's obviously false because that's not a realized valuation. So I wonder if you need to have the amount of fuel necessary to double the valuation that you just raised at. So if you feel raising $1 million at a 20 million post, so you give away 5% of your company, do you feel that's enough fuel, $1 million, to get you to $40 million in value? The answer would, in almost every case, be no, because that buys you 5 developers,
yeah,
or a 5-person team for 1 year to create $40 million in value. Now, if you were to raise $5 million for 25%, that's like a Series A. If you were able to pull that off, that would be enough fuel maybe 5 million would get you 10 developers at $200K each for 2 years or so. Maybe you could build to 40 million, but that would still be challenging to sit there with 10 developers and say, we got to get to this amount of value in 30 months or less.
Right. The rubric that I like to use is to say, what is, how much money does the company need for the next 12, 18, 24 months to achieve the de-risking points or value proof points? And then from there, that's the amount that you need to raise, plus or minus 25%, because you need a little bit of buffer. And then for that, you do a trade for 20, 25, or 30%, depending upon the investor set. And that is the usual trade at the early stage, because it's impossible to actually value a company, when it has no revenues, and it's too, if you and I start a company, you want to raise at, 10 cap or, 5 cap, like the company isn't actually worth anything.
Yeah, it's worth zero. Company. So we're just coming up with something
exactly. It's just
that
a value
feels
trade.
Fair.
Yeah, it's a trade of dollars for ownership. And then the way to think about, so the way that I think about it, and I advise entrepreneurs to think about choosing investors is the same way as choosing your team. So, when you think about the dilution or the amount that the investor should own, it's similar to when you hire a great COO or a VP of engineering. So if we had a startup, if Jason and I started a company and we were to hire a VP of engineering, I'm sure we could find a VP of engineering that's willing to take 0.5% and like 150K per year. I'm sure we could find that. But some of the great ones may ask for 5% and maybe 100K because they care much more about the equity than about the cash, right? And certainly there's going to be a quality difference between these sort of two poles. And so similarly with investors, you'll see the same thing, which is that, you're basically hiring these investors who are going to be on your cap table for the next 7, 10 years, assuming you're successful. And they will be a part of your team for a very long time. So thinking through the trade-off of basically it's dollars for ownership, but then obviously the investors who consider themselves, high value add may expect more ownership.
All right. When we get back from this quick break, I want to know, you talked about the market. We went through team a bunch, which is great. But you also talked about the market, and a growing market doesn't have to be here yet, or a big market that could sustain many players. I think your Lyft investment falls into that. I'm Uber, you're Lyft. We're both pretty happy right now, even though Lyft had a tough time in their IPO. It's still a $15 billion company. That is nothing to shake a stick at. So when we get back, I want to understand how you think about market size when making an investment when the market doesn't yet exist. When we get back on Angel the Podcast. You know sales is hard. I know sales is hard. We're all trying to scale our sales departments at our companies, and it's hard. It's arduous. But you also know that Salesforce is the world's #1 customer relationship management platform. That's called CRM in the business. And now with Salesforce Essentials, you get an easy out-of-the-box tool and support at a startup price point. And that's the key point here. A lot of people say Salesforce, oh, I'm going to wait to do that. Oh my God, it's going to be expensive. No, au contraire, mon frère. Go to salesforce.com/angel right now. Salesforce.com/angel. And you will get a 50% discount on your annual contract and a free onboarding training session. Why are they doing this? Salesforce wants to help young companies grow. That's why they are a partner for Angel the Podcast. It's instant setup. Bing, bang, boom, you're up and running, and you will be scaling your sales team with a full stack solution. It's really easy. You just customize with a couple of clicks and simple integration tools, and you can connect and integrate everything you're doing under one roof, and you'll stand out with full cycle customer support. That means you're going to automatically connect all of your support channels and automate the busy work and repetitive tasks that you don't want to be doing or having humans do. You can just do that all automated. The customers can help themselves, of course, with the self-service tools. That's super helpful for those people who like to just get on and off your website and your CRM really quick to get that help. And you're going to sell more faster. And that's what it's really about. That's the name of the game. You want to increase the velocity of sales, and you get everything you need on one simple screen. You can track emails, you can track calls and meetings from your inbox. The price point is amazing. You get access to the world's #1 CRM at a cost that is fit for a startup. Thank you to my friends at Salesforce for supporting this program and for supporting founders with this amazing deal. And you can get that 50% discount at salesforce.com/angel. Okay, let's get back to this amazing episode. Welcome back to Angel. This is the podcast that is a companion to the book I wrote. If you haven't read Angel yet, it's in Chinese, Japanese, English. What are you waiting for? Go learn Japanese and read my book. Or if you speak English, you could just listen to me for 6 or 7 hours in your ears. I read the book myself. So if there ever was a reason for you to go on audible.com/twist and get a free book, it's to get Angel. All right. And thanks for the reviews, everybody. That means a lot to my mom and me. My guest today, Ben Ling. He is founded his own firm, Bling Capital, after spending 6 or 7 years with legendary Vinod Khosla with the beach issues. Why won't he just let people surf the beach? What's the story there? I referred to this crazy controversy. He bought a beach colony where people used to surf, and then he doesn't want anybody on his beach. This is a terrible look. I told him on Twitter. Just let people surf the beach, Vinod. If you're a billionaire, let people surf the beach. What's the story with his beach thing?
What I will say is what I've learned in working with Vinod is that if you approach him with respect, he treats you with respect. And if you approach him
with a fight?
With a fight.
Yeah, which they did.
He may not respond so positively. But I think that's most people.
I do.
I think that's most people.
Also, we have blind spots. I think sometimes people don't know when it's a bad look. But I understand. Like I read his...
No, but Vinod is very principled. So he believes in his principles.
He's so principled. Yeah. And when I read his position on it, I actually found myself nodding. Like, if you buy a piece of property, it's your property. You should have the right to do it or whatever. Somebody else shouldn't be able to. Property rights are kind of what America is built off of and democracy is built off of. But I have a better solution for Vinod. Vinod, you'll be dead soon. We all will be. I don't think you're ever going to go to this beach. Like, you'll go once or twice. Put up an ice cream stand. Give anybody under 12 years old a free ice cream cone. Let everybody use the beach. It's no big deal. Be a mensch. In fact, the power move for you would be to make it a public park for all eternity after 20 years of using it or something. That would be like the power move. All right. Anyway, enough advice for Vinod Khosla. Why'd you start your own firm?
It was an opportunity. So I actually wanted to do it for a very long time.
Yeah.
I didn't think I had the experience before joining Khosla Ventures to actually really understand all the ins and outs of venture and the aspects of understanding the convertible notes, the conversions, like the follow-on rounds, the per round, so on and so forth. But after 6 years of training at KV, it really gave me an opportunity to sort of branch out and invest in the companies that I want to invest in.
How big's the fund?
The fund is about $90 million. So it's a $60 million seed fund and a $30 million opportunities fund.
What does that mean for people who don't know what an opportunity fund is? We all know what a seed fund is. That's $250 to $2 million checks in 2019 dollars. What is an opportunity fund?
Opportunities fund is usually a fund that follows on from the previous fund, from the seed fund. Yeah.
Got it. So if you hit a big winner, you hit a Cora or a Palantir again, which you will, you can then just plow 10 million or 20 million into it. Does that give you a different level of carry, those opportunity funds, than the main funds? Is that why they're separate, or is it just separate to...
There's different sets of LPs that like different types of risk exposure. So certain types of LPs like the early stage risk exposure and certain ones like later stage risk exposure. Yeah, so in my opportunities fund, I'll write checks probably around 1 to 3 million. So the idea is like somewhere between the target of about 10 companies in the opportunities fund.
Got it. And those would be Series B or something like that?
Yeah, that's generally the idea.
Got it.
And investing out of either the seed fund, following companies from the seed fund or from any of my previous investments as an angel or at Khosla.
Got it. Because this, I don't know if you had the same experience when you were an angel investor. You didn't take your pro rata. You probably didn't even have pro rata. But then you get savvy, and after 50 investments without pro rata, you have pro rata in all of them. But you may wake up one day with a unicorn. This is happening to me over and over again. I have companies I invested in at $5 million that are closing rounds at $250 or $1 billion, and all of a sudden I find myself with $1 million here, $500,000 here, $2 million here in pro rata. I got to take that pro rata, right?
Well, sometimes you do, sometimes...
Maybe not?
Yeah, maybe not.
How do you make that decision?
If the way that I think about it is that if you if you were to make an initial investment in that company in that round, if you're willing to write that check, you should do your pro rata.
Got it.
And if you're not willing to write your initial check in the company,
so just put it to the same criteria you would when you made your first check.
Exactly.
Makes total sense. Hey, when I left our hero, that's you, Ben, I was wondering, you mentioned a market that might appear or might emerge, an emerging market, was okay for you to make the bet if the team was great. How does one accurately assess the market opportunity? How does Ben do it?
Again, this is more of an art than a science. And I think there's a certain spidey sense that you have to have in terms of with the way the trends are moving. Especially in consumer, I think there's the aspect of where do you think the puck is going to be? Because you got to ski to where the puck is going to be, not where it is right now.
Right.
So understanding how consumer behaviors will change. So when mobile came out in the late 2000s, I think we all understood that there was a platform shift. So there's a variety of things that would actually, a bunch of companies that existed on the web, they should exist on mobile.
Yep.
It's actually relatively straightforward thesis, not that innovative, but the opportunity to invest in a variety of companies that were taking advantage of that platform shift. So I think that's a perfect example, which is that it's not obvious. It wasn't necessarily obvious to everyone in 2007 that mobile would be as big as it is today.
Right.
And so
it should have been, but it wasn't.
But it wasn't, yeah. So when the first iPhone came out, it was really, really slow.
Yeah.
If you remember, I think it was Edge, and
terrible.
you could barely browse the web, even on Wi-Fi.
You could browse the web. You basically would load a web page, then take a couple of bites of your slice of pizza, and then pick your phone up again. The web page would be loaded. It was like the worst. It was the worst backup you could have for loading a web page. And your email was loading in the background on your BlackBerry faster, candidly.
Yeah, much, much faster, actually. BlackBerry was much, much better for a variety of business-related tasks at the time. And so, but what you had to believe was that both Apple and Android would continue to innovate, and the Moore's Law would kick into place, and the price would come down, so on and so forth. And then now we have this multi-billion user platform that didn't exist just 10 years ago.
And you'd have to make the assumption that consumers would be willing to do commerce on their phones and that broadband would work. And it's almost like we look at it now, like the idea that you would buy movie tickets on your phone or books or Amazon or groceries on your phone. It's like, well, of course you would. But there was a moment in time when people looked at the web, and I remember people were like, oh, yeah, no, people will not put their credit cards on the internet.
Totally.
In the 90s, that was the position. Like, what maniac would ever put their credit card into a website?
Totally. It ties into a corollary that I have, which is that defaults matter. And this is one of the things that I discuss with founders quite a bit in terms of product design, that 90% of users will choose the default that you set. And the Amazon example is the exact example I give, which is that Amazon had the foresight to say, we are going to store your credit card.
Yeah.
You can go back and delete it if you want, but we're storing your credit card.
Right.
In an era when people were like, oh, you shop online? That's really weird. Like, you trust them with the credit card? Like,
what if it's not your size? What if it's not your size?
Exactly.
What do you do when you get the socks and they're too small?
And so the conventional wisdom at the time was that, oh, if I'm running an e-commerce site, I'm not going to store your credit card, right? So because it's for your privacy, so on and so forth.
Yeah.
But then it turns out to be that Amazon did store the credit card, and then that's one of the reasons why consumers go back to Amazon, because, well, the payment information is already there, so it's one click.
It removes a massive amount of friction.
Yeah.
And by massive, I mean 30 seconds of re-inputting your credit card.
It's more than 30 seconds, because usually you have an error, and then you're waiting for it to load.
So it's 2 minutes of arduous credit card. It's amazing. Like today, we consider 2 minutes of fumbling with a credit card for the reward of getting anything you want delivered within an hour to 48 hours as arduous.
Yeah, well, consumer expectations just continue to rise and rise and rise. So
yeah. So it's almost like, in a way, you should just assume it's all going to work out. When you're like looking at a market, I have now in my mind just said, assume that whatever the technical difficulties are, whatever the broadband difficulties are, just take a moment to assume that all of those things are overcome. So when I looked at like a lot of these VR, AR companies, I just said to myself, let's assume they get these things down to $200. Would people want to do it? And I came to the conclusion, okay, yeah, we'll get to 200. I don't know if it's 5 or 10 or 2 years, but I actually don't find any of the experiences compelling. because I have the $2,000 version and it's still not compelling to me. So I actually think this is DOA. And you know what? I think I called it on this very program, because you can look at it and say, is this compelling? And when I looked at AR, I thought to myself, this is pretty fucking compelling. To like, when I saw AR for the first time 10, 12 years ago in Japan, I was like, wow, you can put things in the real world. What if they could put the Yelp rating above the front door of restaurants? Or what if they could put like a person's Twitter handle above their name? You think AR is going to be big? Is that one we might look at the same way we look at mobile and say, well, it's obvious that market would manifest itself. You know, HoloLens is janky right now, but yeah, obviously they'll get that down to $200 and it will just work.
Well, I share your view on VR. And I think that the product experience is so subpar right now that it's not ready for mass market. And I think a lot of people say VR is just the next mobile, but I think those people are too young to realize that there was, that mobile, there were lots of failed platforms before Android and iOS, like the Palm. Yeah, exactly.
Go.
So, exactly. There's so many failed
Remember
platforms.
Sony Go? What was that called? Go?
I don't even know what it was called.
It was called Go. They had this like Go thing where we had like virtual assistants in the 90s. It was like the entire iPad just before.
Yeah.
Yeah.
So the concept was right. The timing was the timing or form factor, whatever, wasn't right for consumers at the time. So I think the VR experience is far too clunky today. And so from an investment perspective, I think it's very tricky because you bear both A, platform risk, which platform is going to win, and then B, market risk, whether consumers are going to adopt, right?
Yeah.
So, and then you have product market fit risk. So like you have a ton of layers of risk on VR. And so that's why I generally avoid investing in VR. I am bullish on, however, the major platforms investing billions of dollars in it, because I think that actually makes sense. So for Google or Facebook is investing billions of dollars on it,
why not?
They can take a long-term, they can take a long-term view, 10 years, 15 years, invest billions, tens of billions, and maybe they create the form factor that's excellent. On AR, I think that certainly there's a lot of value to that. So I haven't seen anything that I really love from a seed stage perspective. I think it's tricky in the seed stage in particular because I think it requires more capital than most other.
I think I figured it out. Have you been to Sandbox VR yet?
I have not. I've seen the videos though.
All right, we'll go.
Yeah.
I went for the first time. And when you play VR as a group, it is like going to laser tag or going to paintball. I don't know if you've ever done those activities, but people leave those. It's a huge rush. They love it.
Right.
So it is possible that VR will work, I think, in a group setting when we're all in the same room and we experience it like a movie or going to theater.
Well, I think VR does work, but I should be more precise. I think VR works, but people call it the next mobile, but it's more like, to me, I think that there is a market here which is more like, video game console sized, which is a big market.
Sure,
like, Sega, Nintendo, these are large companies, but they're not Apple $1 trillion companies.
Yeah.
Right. So they're multi-billion-dollar companies, which is good.
Yeah.
But there's a difference in terms of scale, like 2 orders of magnitude.
I can see it happening in locations, because what happens with locations is you get this group phenomenon where we all go do it. We're willing to pay a higher price because it's like going out for beers or something, or going out for dinner. So you start putting it in a category where $20 a person doesn't seem like a lot. Right. $20 to buy an iPad game that you play for 100 hours, people are like, oh, that's expensive. $20 to go out and have a beer and chicken wings or a movie, people are like, oh, it's a good fair trade. I got 3 hours of entertainment, so it's about $7 an hour or whatever. And I think that's how this VR thing will shape up. But the AR piece, to me, just thinking about right now, we're putting this phone in front of our face and it kind of kills everything. Having the glasses on, you can still look people in the eyes, but still have the data, right? So as you were talking, we're doing a podcast here. You mentioned a company you're in. It could put like the little Crunchbase profile to the right of your head as you talk about your companies. Yeah,
I believe in the theory. I'm not convinced on the execution. And I think there's also an element of consumer vanity that's not accounted for in AR. And that's people pay thousands of dollars to have surgery on their eyes and risk side effects so that they don't have to wear glasses. Yes. So therefore, the bar for people putting on glasses or putting something on their face, I think requires that the experience be an order of magnitude better than what exists on the cell phone. And so I think that's the bar for me.
Wow. That's a fascinating hurdle. It's a great way to think about it. You have to, like, you know what? I'll give you another analogy that makes your analogy even more insightful. Talking to a computer through Alexa, call me an Uber, or hey Siri, call me an Uber. Like, sorry, everybody whose Uber just got called. Sorry, I just did it to my own. So I'm going to have to pay. Yeah, I know. Siri, why are you so pathetic? Why are you not as good as Alexa? But you think about those interfaces. What just happened to me with my Siri, like her being horrible, you feel like such a dork doing it. It's like the dork factor. Like, is this... And with Alexa, it kind of crossed the chasm for me where asking Alexa for the definition of a word or for the temperature, or the weather forecast was so delightful and perfect that it actually made it palatable. So it's almost like the technology has to not make you look like an idiot or dork when you're using it. Yeah. Like, if it's frustrating to use and you look like a dork wearing a HoloLens, like, it's just not going to happen.
That's right.
You invest in consumer a lot.
Yes, correct.
Is there, you must think, because you raised a fund around it, that there's a massive opportunity. How do you think about Facebook's brutal copying of every pixel that another company does, whether it's that group chat app? What was that group video app that everybody went crazy for a minute? Party something?
House Party.
House Party. Or Snapchat.
Yeah.
How do you look as an investor at Zuckerberg's ability and relentless Borg-like Microsoft circa 90s ability to just target a company for annihilation and never stop? He did it with Snapchat.
There are many things that I don't agree with in how Facebook is run, but that their ability to execute and copy is something that's unparalleled.
Yes.
And
what does that do to you as an investor?
Well, I think that from an investment standpoint, it's relatively straightforward. You want to invest in things that can't easily be copied or that Facebook isn't interested in.
Got it. Yeah.
Or Google's not interested in.
Right.
And what's interesting, as another example, is when I was at Google, we would present plans to Larry, and he was CEO at the time. And the bar was that we had to generate $5 billion in revenue per year for it to matter. Mm-hmm. And so you could see there's lots of opportunities to build really interesting products and services that would do hundreds of millions, if not billions of dollars of revenue, but were quote unquote too small for Google.
Wow.
And so that also represents a really big opportunity. Like, as an example, I invested in Lucidchart, which is basically online Visio. And Google has a whole suite of Google Docs. And my determination at the time, I invested this seed, the founder is an ex-Googler, that this would be quote unquote too small for Google.
Yeah.
And in fact, it's correct. They are now doing, actually I shouldn't disclose their metrics, but they are doing, material double-digit revenue ARR with zero churn. And
Lucidchart.
Yeah, Lucidchart. Yeah.
Just to make charts.
Well, it's online Visio, collaborative Visio. Like, if we're actually, so.
Makes total sense.
Yeah, and so there's big companies that could be multi-billion. PagerDuty is another example. So I invested in PagerDuty at the seed. At Google, we had this system that was equivalent, very similar to PagerDuty.
Yeah,
and I realized that everybody needed it.
The internal PagerDuty was an internal hack-together system that developers would put together just so they weren't interrupted on the weekends when they're, taking care of their kids' soccer plans or whatever.
And so those are, I think, examples of spaces where, a large company, it gets so large that in order for it to matter to them, it needs to be, multi-billion dollars in revenue.
Yeah.
But as for venture investors, if we have $200-300 million in revenue company and we're investing at the seed stage, it'll probably be, a 30, 50, 100x type of company.
Tell me about the anti-portfolio. Tell me about the companies you passed on that make you go, oh my Lord, I suck at this.
Well,
because I have Twitter and Zynga and Tesla as my three.
Yeah.
I wasn't angel investing at the time, to be fair to myself, but I'm just trying to be fair to myself because I actually could have.
Yeah, so I missed Uber, I think because I was in London at the time, so I completely just missed it. And I didn't understand. And I also didn't understand the dynamic because I don't drink. So I was always the designated driver in San Francisco. So it was never like, oh, well, I can't get a cab. Like, this is not that big of a problem. I'm the DD. So so I just fundamentally missed like that sort of usage model.
Yeah.
We had the opportunity to invest in Carta at the Series A. I think I think Henry.
When it was eShares.
Yeah, eShares, exactly.
They launched it at our conference, and I missed it as well.
Yeah.
Again, I wasn't angel investing at the time, but I knew eShares would be huge. Yeah, eShares seems very interesting. Like this ability to have because when you pick, my understanding with Carta now, Carta, and I need to have this fact checked, is that a founder told me that they opted out of Carta because it said if you pick Carta, you default to them being your secondary exchange.
Interesting.
I don't know if that's true or not, or if that's the most recent document, but we have to fact check that because I thought that was a little visionary / heavy-handed.
Right. Well, they're the system of record for your cap table, and then they could do all ancillary services around it.
Right. But why should it default? You said before default matters. Yeah. Defaulting to be your default place to do secondary. I mean, in fairness, you want to have a
seamless, easy. Yeah, exactly.
Seamless and easy, but maybe you want to use NASDAQ.
Yeah, maybe.
Like, I think the Uber secondary that Masayoshi-san did was from on the NASDAQ. I know because I sold some to him. What do you think about foreign money? I just wrote a piece about maybe it's time to take a pause on the Saudi money, given the human rights stuff is headed in such a horrible direction there. Do you have like money from the Middle East or China?
No. No.
How do you think about that? Because you must have had offers like I have.
Yeah.
So you've politely declined. How do you think about that?
I think it's a very important consideration where your money's coming from.
Why?
Because ultimately, if you're delivering a return for those investors, you're supporting whatever causes or initiatives that they undertake. And so I think that, as an investor, if you are trying to better the world and improve the lives of people generally, I think it's important to consider what your investors, what our LPs essentially are doing with the money and what worldview they hold.
We're going to get rich no matter what. But
I don't know no matter what, but...
Well, with your network in Silicon Valley, with your track record, I would say at this point, you would have to, if you tried to not win, I think you would break even because your deal flow is so great and your network is so great. With the assumption that you're going to do reasonably well in double, triple, quadruple, 5x people's money, which is the expectation for these smaller size funds, is that we're going to, 3, 4, 5 exit. People feel pretty good about us. We can raise another one. If you 1 exit, 2 exit, probably not. You might be on the wrong side of the conversation and raising another fund. But do you want to 5x money for a group of people who are murdering journalists? Or,
I don't think so.
Yeah, or arresting journalists and writers and thinkers and artists? I don't think so either.
Yeah, and I think entrepreneurs should ask where the money's coming from.
Well, that's an even bolder one. Yeah, because I had an offer from a fund of funds, or I had a discussion. We didn't actually reach formal. And I said to them, I'm just curious, do you have any money from Saudi Arabia or from other places where I might disagree with? I think I said, we have one Saudi family. And I said, well, this is an interesting thing. And I said, can I ask, what percentage of your $5 billion fund of funds? He says, it'd be less than 1%. It's just one family's little thing. And I was like, okay, well, overall, I might feel okay with that percentage. And also, maybe it's a Saudi family who is super progressive and they don't agree with murdering journalists and dismembering them in a coordinated hit happened to Khashoggi. But what is the point of being rich and powerful and notable and getting to the point that we've gotten to in our careers where we actually can steer history, we can steer where business goes, we can steer where humanity goes, even if it's just a little bit on the rudder, right? Just a little bit of fuel. What's the point of reaching this level of success if you have to then have humanity go backwards?
Yeah, completely agree.
It doesn't make any sense. For what? For an incremental, if I had known...
well, especially in the world where there's many sources of capital, right? Especially in that world.
Right. It makes it even more perplexing.
Yeah.
And I guess, why do people do it? Because it's just easy? I don't know.
Neither you nor I took money, so you have to ask them.
Yeah. It's really interesting. I think what it is like, if you think about it, if you can mark your portfolio up 1 year out, I guess that feels so good to people that it's easy to take it. Like, as an entrepreneur, if you took money from Masayoshi-san, well, I respect Masa, but I may have problems with 50% of his LP base, which is the Saudi Sovereign Wealth Fund. I think people need to take a stand right now. Like, this is the moment. If you're an investor or a founder, if you're a founder and Masayoshi-san comes, you should ask him and his team, will you invest in me without the Saudi money? Will you carve that out? Can you do that? Obviously, they can't. But I think that's the message that needs to be sent by the powerful Silicon Valley CEOs now.
Yeah, I think it's something they should definitely be thinking about.
Yeah. All right. Yep. Well, this week in Alienating 1/3 of Silicon Valley, me and Ben Ling. Ben, continued success. It's been great working with you. You know, we get to collaborate on things, and it's just refreshing that every time I send a founder to you, they come back and say, you spent so much time, gave me such great feedback, whether you invest or not. You're always doing the work and taking the time, for which I am very grateful, because I try to do that as well. And I am just perplexed sometimes when I send somebody to a notable firm and they send an associate and they spend 20 minutes and that associate's on their phone and they don't know why they're in the meeting. You take the time. And that's what this is about, is putting in the work. If you are starting a company, you got a little bit of traction, whatever, Ben is as good as it gets. As far as I'm concerned, we're going to be sitting here in 10 years. I think you're going to be like, you know, right at the top of the list of first people to call. And really, congratulations on your new fund. I think it's tremendous. It's been great to work with you.
Thanks for having me.
All right, my pleasure. We'll see you next time on Angel, the podcast.